and welcome back to AHIC. I hope you all enjoyed the wonderful reception we had last evening at the Rotana Jadaf. Some of the pictures rolling from last evening right now. My name is Ali. I'm a colleague of Jonathan and Jennifer's at Bench and Minaz and the lovely team that has helped put together this event for you. We'll quickly start day 3 with a global and regional outlook in the era of digital transformation by Dr. Henry Azzam, who is the Senior Lecturer of Finance and Director of the Masters in Finance program at the Olayan School of Business, American University of Beirut. So please, Dr. Henry.
Good morning. Thank you, Ali. Ladies and gentlemen, it's my pleasure to be here. I still remember when I was a speaker in 2009, 2010, wow, 11 years ago in this conference. Time really flies so fast, and we're all getting older, but I can tell the audience is getting younger. The Delta variant is leaving an impact on the world economic outlook, especially in the contact-intensive sectors that are affected by this variant. Now, this is impacting certain sectors, slowing them down at a time where we have massive fiscal and monetary stimulus being injected. In the G20 countries, more than 8.7 trillion has been injected to activate the economy. So demand is picking up. We're seeing prices rising there at a time where supply is also constrained by supply chain bottlenecks and other COVID-related constraints. So these two combinations are leading to higher prices, but we will argue within a few minutes that this is unlikely to last. Another point is what the governments worldwide are doing. They are implementing quantitative easing. They go in, reducing the supply of long-term bonds. When they take them out of the market, supply shifts, prices of these bonds go up, automatically yields will go down. So they're trying to maintain lower yields on the long bonds, 10-year and above, so that long-term funding costs to companies will stay lower, encouraging more borrowing, at a time also where monetary policy is so accommodative, maintaining short-term interest rates either at 0 or sometimes below 0. We have seen prices picking up recently. In the last 3 months, June, July, August, consumer prices averaged above 5%. I mean, when you compare this to the Fed target of 2%, they are sizable. However, again, this is unlikely to last. Not only in the USA, but also in the UK, in the EU, we have seen surge in prices, perhaps to the highest level in a decade in the EU. When the constraints on the supply side become less effective, when the consumer-induced higher demand because of government expenditures start to ease, when tapering commences, then we could see inflation going back to more to levels close to 2%. Now, mind you, a touch of inflation is not bad. Japan has been trying to get out of a deflationary situation for such a long time. So having inflation 2.5% is something positive because it adds to the revenues of companies operating. If you look at this chart, the yield on the 10-year government bonds, around 1.3, it closed yesterday 1.33. what what is this yield telling us? Well, it went down from a peak of 170 in February this year to where it is now. So it's telling us that markets, the decision of thousands of investors, are not expecting any tapering of quantitative easing anytime soon. So it's not yet priced in the yield. With all the fiscal stimulus that we talked about, in the USA this year they're talking about 3.5 trillion budget with 1.2 trillion infrastructural expenditures. All of this will push growth higher. Notice the 6.7% growth this year after it has been negative last year, 6.7 this year, slightly lower, but still sizable growth in 2022. So notice what's happening. We have the contact-intensive sectors, the tourism, the travel sectors that being negatively affected by COVID, Delta, slowing down. So at the micro level in these sectors we have slower growth, but at the macro level they are more than compensating by having expansionary policies, ample fiscal stimulus, ample monetary stimulus. Thus, where micro takes, macro gives. Slow in certain sector, but much higher growth in others. Looking at this balance, if you want, neither inflationary nor depressionary, so where we are today in terms of interest rates and yield, no one expects short-term rates to rise anytime soon. We still have weaknesses. Inflation picked up, but it's going to slow down. So short-term interest rates are likely to prevail at least well into next year. The problem is China. The China economic outlook was affected by what's happening with its highly indebted developers. Evergrande, Fantasia, and others, which have been borrowing so much. Evergrande has 300 billion debt outstanding, 100 billion bonds, euro bonds issued. I mean, this 100 euro bonds, lots of international funds went into them. So if there is a risk of default, clearly China will be affected. We have seen on Monday this risk of default, it led to a panic selling in the Chinese capital markets that moved to Europe and the USA, and we have seen selling as well in the USA. However, China, among the very few countries in the world that recorded positive growth in 2020, its growth this year, because all what's happening, is unlikely to exceed 5.3%. But keep it in perspective. Before COVID, China used to grow at 8-9%. So to move from there all the way to 5, it's a considerably lower growth. Did we have contagion on Monday? I mean, look, this is the movement in the US stock market, looking at the largest 500 companies, the index of the largest 500 companies. I mean, since the beginning of the year, prices were going up. We have more than 21% increase in the S&P 500 starting from the beginning of the year till reaching a peak on September 2nd. So the market was waiting for something to correct, and they looked at Evergrande, they looked at the panic selling in the Chinese economy and said, okay, it's time to take profits. I would have loved to see the correction more than 4%. We have 4% correction. I mean, throughout when you're going up, you need these corrections to build a solid foundation to grow. It didn't. We got 4%. Hopefully, we will get slightly more than 5%, and then, boom, we have to get into the market. Our expectation is that we will end the year close to from 4,500 high to close to 5,000. So this is still fundamentally solid. Look at what's happening. Slight inflation, good for revenues. Cost of borrowing is low. Both long-term yields are low at 1.3, but short-term close to 0. And demand is picking up. So it's a combination which is conducive to good performance in the US market. Especially things will start looking better once the conditions related to that start to be less of a constraint. So looking forward, the US stock market is the place to be, and also the other major stock markets. So we're looking at a growth in the USA. Let me see where I have it. Yeah, growth in the USA next year, but also in Europe. What's happening in Europe? There is this index of surprise, economic surprise index, which is collected and measured by Citigroup worldwide. For Europe, suddenly and for the first time, the index went into negative territory. What does this index say? It looks at expectations, it looks at real data. If real data is below expectations, the index becomes negative. So it pulls expectation down. It forces people to adapt their expectation to the reality, bring it down, and therefore they act accordingly. So yes, when it starts going down, it might continue a little bit, but eventually Europe is still will do well because of the robust demand that we have there. And we're looking at growth of 4.4% this year, 4.5% in 2022. But a slight slowdown so far this year. I am moving from the international to the regional, and this is the link, oil. Whatever painting you want to draw on the region, especially the Gulf region, it has to be an oil painting because oil is everything. Look at what's happening in the oil. Prices increased by more than 40% so far this year, reaching $73, $74 a barrel for Brent crude. So 40% increase in prices, but also output has risen every month since June 2020. Now, when we look at GDP, if we're looking at real GDP growth, we're taking prices out, so prices are less of a factor. It's more the actual level of production, which is important. Production have been rising. So between the two, pricing and production, oil revenues, supporting government expenditures, infrastructure expenditure, etc., would give a good push to economic growth of the oil-producing countries. This is not my estimates. These are the expectations of the International Energy Agency, IEA. They're looking at an average oil price of 67 in 2022 compared to this year average estimated at 69, which is sizable. It was 40 or just below 40 in 2020. So a big jump in prices, in revenues. Add to it output, so you have sizable increase in production. MENA. The outlook for MENA, it's a combination of different economies with different strengths and weaknesses. Total GDP of 3 trillion, 23% of that in Saudi Arabia, so this is a huge economy there, 23%. Half of MENA's economy is in the GCC. The second largest, UAE, 450 billion. So the GCC is what happens in the GCC pushes the whole region one way or the other, either through investment, remittances, or what have you. MENA suffered in 2020 negative growth of 2.8 on the average, both Gulf and other countries. So the overall GDP is expected to pick up to 2.5 this year and 3.4 in next year. Again, for all sorts of reasons we talked about. So talking about averages is fine to give you an overall view, but let's dissect them now. The GCC economic recovery is accelerating because of what we said about oil, about government expenditures, etc. There's so much information here, so many numbers, but look, if you look at 2020, the negative growth in the region very much followed what happened, closely tracked what happens in the rest of the world. We had negative growth in the largest economies of the world and the world composite because the region is exporting oil and gas, travel and tourism. All of this has to do with the health of the world economy. The region suffered in the process. More so in countries like Morocco, Tunisia, which depend a lot on tourism, and as well as the oil countries. I mean, Egypt look odd. It's not that odd. The fiscal year of Egypt starts from July 1st till June 30. So in the 2020 figures, we have half a year of 2019, which was a strong year. So the strong half year of 2019 added to the first half, weak half of 2020, and the average came out to be slightly positive. This is why when you look at 2021, not much rebound there in the figure for 2021. But for the MENA in general, we're seeing how growth is going to pick up. We will not reach pre-pandemic levels, and I'm looking at 2018, not 2019 pre-pandemic levels before 2023. An interesting story in the region's equity market. They were quite weak for a long period of time. You know that when the stock markets are not doing well, we in economics, finance, we have what we call wealth effect. People feel less wealthy, so they don't go out and consume more, so less consumption. And when the stock market is not doing well, there will be less IPOs, less investments. This had changed. Notice the increase, the good performance of the pan-Arab stock market, 27% year to date. Hopefully, we will end above 30%. And the strong performance in Saudi Arabia, 35%, UAE, 33%, Kuwait and Jordan. I mean, Jordan and Kuwait so all the region, the stock markets have been doing reasonably well, fine. What does this tell me? Wealth effect, people are feeling wealthier. They will go out and consume more, but we'll see, and we're seeing, more IPOs will be coming to the market. So companies are raising equity. Debt is cheap, and they are now raising equity in a relatively cheap way because the best time to raise equity is when the stock market is doing well. So this should reflect positively on the economies of the region. Two caveats. First, Saudi Arabia is a giant. 73% of total market capitalization of the region's stock market is Saudi Arabia. Not only how big it is, but also the fact that Saudi institutions, individuals are investors in the other Arab stock markets. So we need to keep a close eye on Saudi Arabia. Second, these markets are not efficient. What do you mean by efficient? When all the information is in the price, then we say the market is efficient, and therefore it becomes a leading indicator of economic growth. These markets are not efficient. We don't have many companies listed. Average daily trading volume is relatively low. We have fewer investors than elsewhere. It's nothing to be compared with the US or Europe. So we should not look at them as a strong leading indicator. It's a good indicator, but it is not as much of an indicator as the US market would be. Now, the other half, we looked at the GCC, strong performance. The fragile and conflict-affected countries, we added another one to them. We had Iraq, Libya, Syria, and Yemen. Now you add Lebanon. Lebanon is in a big mess. The 35.2% performance in the Lebanese stock market doesn't mean anything. All the dollar trapped, the $100 billion deposits trapped in the banking sector, they can be utilized in one or two ways. Either in real estate investments, where the developer has outstanding loans to the bank, so he takes the money from the investors and give it to the bank, or invest in the local stock market, a very thin local stock market denominated in dollars, Lebanese dollars, so which you cannot take out. Now, if you compare the exchange rate at 1,500 to the exchange rate now of 20,000 or 15,000, we have to bring this down by 10 times. So Lebanon is there. The countries that depend on tourism, the 4 countries where tourism constitutes 15%, will recover more slowly than others. And we have seen sizable increase in budget deficits, sizable increase in funding requirement, partially offset by the IMF largest SDR allocation in its history. They allocated back money to all member countries, including MENA. Saudi Arabia got 13.5 billion. Morocco got 1.2, Lebanon got 1.2, Jordan 500 million. So these were helpful, these were good contribution to the economies of the region. I don't know if I have time, but I want to say a few words about digitization in the region. We have noticed that customers, mainly in the GCC, are becoming more of a digital converts. They're buying increasingly almost everything online. The MENA e-market, estimated at 12.1 billion in 2020, recorded a sizable growth rate of 54% and estimated to reach 30 billion by 2023. Notice what MasterCard study showed: high digitization among women-owned businesses and the increasing use of digital payment generally being accepted. The fintech investments related to the finance field led the growth in MENA digital economy. 1 out of 4 deals has been in fintech, and they attracted 30% of all funding. We noticed, as if it's happening internationally, it's happening in the region, the stand-alone digital banks, what we call neobanks, are now surfacing, facilitating the move to a contactless and cashless banking experience. Examples of neobanks: there is Reflect, recently introduced by Arab Bank in Jordan with ambitions to go regional. Mashreq Neo and CBD now are both here in the UAE, standalone digital bank. Standalone does not mean a subsidiary. It could be part of the main bank, but they are providing a completely online banking experience. Saudi Digital Bank, Ayla Bank of ABC in Bahrain, and they are spreading. Lend soon will come. So this is an interesting development. Index of modern financial technologies, notice number 1 was UAE at the high, followed by Saudi Arabia, Bahrain, Tunisia, and others. I I don't know if I have time. Do I have time to continue? Give me 5 more minutes. Yeah. This is a fact. Digital disruption is happening. Every company, the challenge is so big, and every company has to find the way itself. There is no one single way to follow. But what is common among all successful digital transformations are that a willingness to be bold. What does that mean? You have to move fast. The train has left the station, going at a fast speed. You better be on it. So be bold, create a different product. Leverage technology to achieve 2 things. On the supply side, higher operational efficiency, and on the demand side, enhance consumer preferences. But the constraint, as we have been seeing it, is the leadership. Can CEOs become digital natives? Can they converse with the digital natives they have? It is a very young trend, and you need to be there, and to lead your organization. The CEO and the board have to become digital natives, and this is a constraint that needs to be addressed. I have been working with a company, consulting with a company called ProgressSoft, which has to do with digital payments, to do online banking, etc. And I just summarized the winning approach to digital transformation here. Forget about the existing infrastructure. You have to come up with a new digital foundation. Definitely. You cannot just improve on what you have. You have to close that and open a new chapter. As we move from physical to digital, you need to give your customers a personalized omni-channel experience that seamlessly combine physical outlets or branches in terms of bank with digital challenge. You need to disrupt, or you will be disrupted. So you need to launch an entirely new business to attack and capture opportunities. 6 growth themes, all of us have been reading about them. I just summarized them here. Digital infrastructure, conferencing, live streaming, gaming, fintech, artificial intelligence, machine learning. This is what's closer to my field. Neobanks, we talked about them. Central bank digital currencies. Many central banks in our region, as well as abroad, are thinking of introducing CBDC, central bank digital currency, in order to move more things online, cryptocurrencies, e-commerce, etc. This is my final chart. It summarizes also the digitization strategic priorities, build capabilities, both execution through training, and upgrade your digital channels. Make sure you keep expenses as low as possible. Keep things online. We have been doing excellent board. I sit on the board of 3, 4 companies, and we have been having meetings online, committees and boards. So let's continue, because this would lower expenses. Don't try to do it on your own. This is highly entrepreneurial. You don't have the entrepreneurship capabilities inside your company, maybe, so acquire IT, and in the finance sector, banking, fintech companies, they know how to do it. De-risk is very important. By de-risking, reduce leverage. More of your cost should be variable cost rather than fixed cost, and stabilize your operation to the new normal that we have been talking about. Thank you.